Hello students, I am Dr. Rashmi Chawla and I will be teaching you cash management. Cash is the basic requirement to keep the firm running on a continuous basis. At the same time, it is the ultimate output expected to be realized by selling goods and services. A firm should hold sufficient cash, neither more nor less. Excessive cash remains idle, it simply increases the cost without contributing anything towards the profitability of the firm. And in the opposite case, trading or manufacturing operation will be disrupted. Not only that, it largely upholds under given condition the quantum of other ingredients of working capital, that is inventories and debtors, that may be needed for a given scale and type of inventories and debtors that may be needed for a given scale and type of operation. Cash is no doubt a most important asset, and that is why a firm wants to get hold of it in the shortest possible time. In the absence of sufficient quantity of cash at the proper time, payment of bills, including dividend and others, may not be made. Cash management, as the word suggests, is the optimum utilization of cash to ensure maximum liquidity and maximum profitability. It refers to the proper collection, disbursement, and investment of cash. For a small business, proper utilization of cash ensures solvency. Hence, cash management is a vital business function. It is a function that manages the collection and utilization of cash. Now, cash management involves three factors. All, you should ascertain the minimum cash balance. There must be a proper arrangement for the collection of cash and payment of cash in such a manner that minimum balance can be maintained. As already I said, there must be optimum level of cash, neither more nor less. Surplus cash can to be invested to temporary investments to be invested in fixed assets. See, what is optimal level of cash? Optimum level of cash means there must be a balance of cash which is to be maintained in the organization or a firm. If you maintain more cash, in that case, there will be an opportunity cost. And if you are keeping less cash, in that case, if there's any kind of contingency or any kind of need for purchasing raw materials, production may be disrupted. So there must be an optimum level of cash which is to be maintained. Objectives of cash management. Now, what are the objectives of cash management? This generally answers why do we need to manage cash flow in the organization? What is the use of management in the business? So first is fulfill working capital requirement. What is working capital requirement? Already we have discussed what is working capital. Working capital is the difference between the current assets and the current liabilities. And here, the organization needs to maintain ample liquid cash to meet its routine expenses, which possible only through effective cash management. Planning capital expenditure. It helps in planning the capital expenditure and determining the ratio of debt and equity to acquire finance for this purpose. Like for example, if you want to start a certain project, if you want to purchase a machine worth crores, in that case you need cash. Handling unorganized costs. There are times when the company encounters unexpected circumstances like the breakdown of machinery. These are the unforeseen expenses to cope up. Cash surplus is a lifesaver in such conditions. That is in case of any contingency. Very important. Also initiates investment. The other aim of cash management is to invest the idle funds in the right opportunity in the correct proportion. Better utilization of funds. It ensures the optimum utilization of the available funds by creating a proper balance between the cash in hand and investment. That means you must have a balance between how much cash you have to keep in hand and how much you need to invest. Avoiding insolvency. If the business does not plan for efficient cash management, the situation of insolvency may arise. It is either due to lack of liquid cash or not making a profit out of the money available. Next, we come to functions of cash management. Cash management functions are what? First of all, investing idle cash. company needs to look for various short-term investment alternatives to utilize surplus funds. That means if there is any kind of idle cash which is being kept, idle cash means what? The cash which you have kept in the organization, which has not been deposited in bank or which has not been into any investment. So the first function is what? Idle cash leads to opportunity cost. This cash can be invested somewhere else. So in that case, this idle cash is earning nothing. So the first function is investing the idle cash, controlling cash flows. Restricting the cash outflow and accelerating the cash inflow is an essential function of the business. Controlling cash flows here means what? There are two types of cash flows. One is cash outflow, other is cash inflow. When we talk about cash outflow means what? Cash outflow is the investment which you are making, and cash inflow is the returns which you are getting in the years to come. Now, they are saying that here restricting the cash outflows should be restricted and cash inflows should be increased. Planning of cash. Cash management is all about planning and decision making in terms of maintaining sufficient cash in hand and making wise investments. That means there must be planning of cash, how much should be kept in hand and how much should be invested. Managing cash flows, maintaining the proper flow of cash in the organization through cost cutting and profit generation from investments is necessary to attain a positive cash flow. Positive cash flow, if you want to maintain, how will you do it? They are saying there should be less amount of wastage, there should be cost cutting, there should be more and more amount of profit generation from investments. Optimizing cash level, the organization should continuously function to maintain the required level of liquidity and cash for business operations. Already discussed with you, this is optimum level of cash. That means you have to decide how much is the optimum level of cash which you need for the organization. It should not neither be more, it should not be less. Next, we come to cash management strategies. Now, we have discussed the 5 strategies over here. First of all, the business line of credit. The organization should opt for a business line of credit at an initial stage to meet the urgent cash requirements and unexpected expenses. Second, money market fund. While carrying on a business, the surplus fund should be invested in the money market funds. These are readily convertible into cash whenever required and yield a considerable period profit over the period. Lockbox account. This facility provided by the banks enable the companies to get their payments mailed to its post office box. This lockbox is managed by the banks to avoid manual deposit of cash regularly. Sweep account. The organization should avail the facility of sweep accounts, which is a mix of savings and fixed deposit account. The minimum balance of the savings account is automatically maintained and the excess sum is transferred to the fixed deposit account. The last, cash deposits. If the company has a sound financial position and can predict the expenses well, along with availing of a lengthy period, it can invest the surplus cash in the cash deposits. These cash deposits yield good interest, but early withdrawals are liable to penalties. Next, we come to the motives of holding cash. This is very, very important. Basically, there are 3 motives of maintaining the cash. Now, what are these 3 motives? The first one is the transaction motive, the second one is the precautionary motive, and the third one is the speculative motive. The transaction motive refers to the holding of cash in order to meet the day-to-day transactions which a firm carries on in the ordinary course of the business. Primarily, these transactions include purchase of raw materials, wages, operating expenses, taxes, dividends, etc. Precautionary motive. This motive for holding cash has to do with maintaining a cushion or buffer to meet unexpected contingencies. The unexpected cash needs at short time may be the result of uncontrollable circumstances such as floods, strikes, droughts, bills which may be presented for settlement earlier than expected, unexpected delay in collection of trade dues, cancellation of some order for goods due to inferior quality, increase in the cost of material labor. Last, the speculative motive. This motive refers to the holding of cash for taking advantages of expected changes in security price. In other words, when the rates of interest are expected to fall, cash may be invested in different securities so that firm will benefit by any subsequent fall in the interest rates and rise in security. prices. On the other hand, when the rates of interest are expected to rise, the firm should hold cash until the rise in interest rate ceases. The precautionary motive is defensive in nature, while speculative motive represents a positive and aggressive approach. Cash conversion cycle. What is this triple C? The cash conversion cycle is nothing but it is also termed as net operating cycle. It attempts to measure how long each net input money is tied up in the production and sales process before it gets converted into cash received. This metric takes into account how much time the company needs to sell its inventory, how much time it takes to collect receivables, and how much time it has to pay how much time it needs to pay its bills without incurring penalties. Triple C, that is cash conversion cycle, is one of the several quantitative measures that helps evaluate the efficiency of the company's operations and management. A trend of decreasing or steady on cash conversion cycle values over multiple periods is a good sign, while rising ones should lead to more investigation and analysis based on other factors. One should bear in mind that cash conversion cycle applies only to select sectors dependent on inventory management and related operations. Now we come to the formula for the triple C cash conversion cycle. Cash conversion cycle is equal to DIO plus DSO minus DPO. DIO is days of inventory outstanding, also known as days sales of inventory. DSO stands for days sales outstanding and DPO stands for days payable outstanding. So I hope this lecture helps you. Thank you so much.